Thank you for watching Junior Mining Talks. My name is Antonio, and as per usual, I'm here with Luke Den Hava. Luke, the GDX is up 20% since the beginning of the year. Is this the start of a new bull market for mining stocks?
I came with this idea of these short questions, and now you get me these type of things. Yes, answer is yes. I think so.
Greg, what do you make of it? Is this the start of a new bull market?
For junior mining stocks,
Yes.
I think yes. I think you've been in a bull market for the majors actually going back to, if you look at the low of December of 2015. So, they've been steadily climbing since that point, but the juniors have been, certainly orphaned during this whole period.
Hmm.
I believe that, they're just it's very the infant stage of a bull market for the juniors.
Hmm. Look back to you here for a brief second. Do you think that the bull market, what Greg is saying here, do you think that the bull market for the miners is going to translate into a bull market for the juniors as well?
Yeah, if there's a true bull market, yes. I just feel like, and maybe the answer shouldn't be this long, but you can always have this 2020 moment or this very quick capitulation period, and it's always way easier, of course, in hindsight, to put the start and end of bear markets and bull markets. And when you're in it, it's quite difficult. So yeah, I do think there's a good chance. And if there's a true bull market, I also think the juniors will participate.
Before we start getting into the actual conversation here, though, I would like to warn everyone listening and watching that we have not received monetary compensation for the production of this video from anybody. However, you still need to understand that this channel is a business that sells content producing services to companies, which means you cannot rely on this video for research. Research is conducted by reading official company filings, which you can find on setterplus.ca. Please only watch this if you know what you're doing. This interview is intended only for experienced junior mining speculators because mineral exploration, development, and mining is a very tough business where failure is the norm and should be the expectation. This is going to be a conversation that is general and impersonal in nature, containing forward-looking statements. I am not a licensed financial advisor, neither is Luke. So before continuing on, please do talk to an investment advisor with a good long-term track record because your capital is at risk. And we are neither licensed financial advisors, nor do I personally have a good long-term track record. If you're not 100% sure you understand 100% of the disclaimers that I just showed on your screen, please go to the last section of this video and do not consume this content unless you fully understand and agreed with everything said herein. That all said, Greg, let's kick it off maybe with what's most topical right now. The gold miners have been announcing their Q4 earnings results, giving us kind of a bit of a more of an insight into how 2024 turned out. What are some of the trends that you're seeing across these earnings there's a lot of trends, but what are you paying attention to the most? Cost, revenues, margin expansions, what's catching your attention?
Yeah, I mean that's certainly what we're paying attention to is okay, how are you able to capture the increased margins? And it still remains a story of cost discipline. The inflation in the mining business has certainly slowed down. So are you changing? Then you can actually, the fourth quarter usually is a period where a lot of companies back end load their production profiles, and so the fourth quarter is usually their best quarter. The first quarter is usually their worst. Why that happens, they always talk about mine sequencing, but you'd think you'd try to even it out a little bit more, but it almost seems across the industry that Q4 tends to be their best quarter. I don't know if that's the bonus quarter, is why everyone drives it, but we're looking for capturing that margins, and what does next year look like, and are you starting to change mine plans in order to mine lower grade material that wasn't economic before? What you want to see is the mining companies keep their margins, and there's no leverage in the mining business if all you're doing is keep continuing to lower your cutoff grade, and then your costs go up. So you want companies that are going to, balance the capital that it takes to build a mine with a deposit and making sure they can have it long enough. I mean, there is a balance there, but there's also, you have to be able to capture margins. And without that leverage, you're not going to have investors in the gold space because that's what they buy it for, is the operating leverage.
That's actually a good point to talk about what I mentioned at the beginning, which is that the GDX is doing well, the GDXJ is doing well, but it's still not doing as well as the free cash flow margins growth that these producers are seeing is. And there might actually be an argument to be made that they're undervalued based on that metric. But why do you think that is in the first place? Why are the miners not doing even better given the underlying conditions in their financials?
It's capital flows. I mean, you have to have additional capital flows into the space. I mean, the gold funds, precious metals equity funds are still a fraction of where they were in 2011. And so, the generalists, they still feel burned from the last cycle. And so they haven't come back, and there's other places. There's an opportunity cost that people view on holding gold assets. So yeah, you have to really break down on the other opportunities, and mostly that's the Nasdaq. I mean, if you go look at gold Nasdaq ratios and pull up those charts, you'll see where and the HUI and Nasdaq, and you'll see where you are on gold relative to tech, and that's that whole new economy, old economy capital flows, and so, but you want to buy when. You want to buy when it's the opposite. And so, it's still, people are like, oh, the gold's up too high. It's not, a good time to buy. It's actually a fabulous time to be a buyer for these assets.
In terms of triggers, if $3,000 gold is not doing it for the miners, do we probably need, a bear market in tech or in other markets, or do you think there are other triggers for a market to start?
I think that is the biggest issue, in my opinion, is that you need to have the opposites takes place here, where you get the yin yang of breaking down on the Nasdaq and the broader market, and gold assets are viewed as defensive. So then you start to get the capital flows, and since you'll be seeing on a relative basis that margins are good versus especially if you went into a recession, that they would stand out, so they would attract capital. So we're getting, I think the setup is good. It's just, and there have been winners. I mean, you can't deny that, there haven't been winners out there. It just hasn't been, just across the board. And then if, some company, whether it's the algos, it gets picked up, where they miss by 3 pennies and the stock's down 5 or 6%. I mean, look at, Agnico's earnings the other day. I mean, they're record free cash flow, record, basically across the board, and stocks down 5%. So but there's definitely have been winners. I mean, Alamos has been a winner. I mean, Anglo Gold's been performing well. You can they also got hit by 4 or 5% the other day, but had looking as good as they have in years. And then you have stocks like Lundin Gold up their dividend 50% yesterday. So there's a lot of real bright areas in the gold space right now.
Which you're throwing out a couple of, or you're throwing up a couple of names here, Greg. Which producers have impressed you this earnings seasons, and have any of the ones that you thought were going to do well, have any of them disappointed you?
I haven't been disappointed really at all. Yeah. So I can't, I mean, looking at, even if the market sells them off, like Oceana the other day, I'm still looking down the road to, okay, just because you might have, had a little softer quarter, in the fourth quarter, that the market was hoping for. But if you look at, where you're really going to be harvesting cash, and hitting on all cylinders, it might still be a couple of quarters out. But in the case of Agnico, I thought they're still hitting it out of the ballpark. Alamos is doing extremely well. Newmont, um, you know, Barrick, they're like I said, they're all kind of Q4 weighted. I mean, their costs seem to have stabilized a little bit. The big ones do tend to set the tone for a narrative for the sector. So what we have is a I think the fact that they are generating significant free cash flow right here will be bullish for maybe attracting more generalists to the space.
Is there?
Go ahead.
No, go ahead, Luke. You can go ahead.
Well, in terms of M&A, I think Alamos did really well, and they are sort of very proud that they acquired in the bear market and right now are doing very well because of acquiring companies and projects in 2015, 16, and a couple of smaller companies, I think, in the last couple of years. And Newmont is selling projects. Agnico is not very aggressive. They basically jump on something when the opportunity is there. Do you think there's still majors around that are really looking for M&A, or do you think most of them are really in that mode of showing investors we can make money for you?
I do think that there is that merry-go-round of replacing reserves and replacing production. The Newmont story is interesting in that you acquire Newcrest and then you flip off all these assets. And they had done that before with Normandy, where they ballooned out to 7 million ounces, went back to 5 million ounces, bought Goldcorp, went up to 7 million ounces, back to 5 million ounces. But you keep on issuing shares. I mean, they are doing share buybacks. So, you'd have to go back and look at, what has been that cost and has that been a good trade for them? But you have to, probably Agnico and Alamos too. I mean, you do get rewarded for increasing your production and your reserves per share. And what it's been tough for like Newmont is been able to do that. They haven't been able to increase that production on a per share basis. And so, but are we going to see some of the bigger projects that tier one projects, assets, from an exploration standpoint? Yeah, I think that there is definitely demand out there. I mean, I think Anglo Gold is certainly still active. I think Barrick, if they see the right opportunity in North America, I think they would act. I mean, but the problem with Barrick and also Newmont, and maybe this is turned off certainly some precious metals investors, is the fact that they have dedicated so much capital towards expanding copper business, specifically on Barrick's side. So that's turned off some precious metal investors. I think that there is appetite for M&A. I don't know that how much the bigger guys are going to do it. It would be a one-off project. I mean, there'd been a lot of speculation of whether or not Newmont would turn around and try to maybe do something with their with Lundin Gold, since they own a big chunk of it already. But that's gotten pretty expensive.
Newmont's expensive?
No, Lundin Gold has gotten expensive for Newmont to make that acquisition, to buy the 68% that they don't already own.
You bring up a good point, which is who's next on the M&A train, and that's something I do want to get to. But maybe you should take a step back and talk about whether M&A in the first place is something that these producers should be doing with the cash. I mean, they are making money. There is free cash flow. There's margin expansion. Is M&A the right move here? Should they be doing dividends or buybacks or just hoard the cash? What do you think they should be doing here?
It's a combination. You have to take, and I think I might have mentioned this to you before, is that the business historically does not look at each project with high enough returns. And so, it's a risky business. It takes a long time. The returns have to be on projects. You can't have, a low single digit IRR on a return on a project for a new mine because you have to be able to generate the cash that allows you to sustain the business, pay back the capital, and pay back shareholders for being there. They need to participate in each hole in the ground. You can't, I've always said this, that it's a fool's game to, take money from one hole in the ground, put it in the next hole in the ground, and the next hole in the ground, and the shareholders get nothing out of it. So that's why you have to be rewarding the shareholders along the way. And that means, you've got depleting resource. It's an extractive business that needs to have, participation in cash flows by shareholders. So that being said, when you have big moves like this, the cash is going to increase. And so if you want to really do accretive deals, you do it with cash and not shares. So that's my opinion. So
maybe we can also talk about their production here in the first place, because you are mentioning cash. Would it be a good move for them to just park the gold for a second, either just, I don't know, literally stack it in a vault after it's being produced, or even leave it in the ground, don't even mine it? And I understand it's a silly business decision, but the market can be silly at times. So could holding back production or sales help the valuations of the miners here?
That is always, that's a question that gets thrown to a number of CEOs, and they say, oh, well, we're in the business of mining, and so we're trying to generate cash. Well, it's that then comes down to what's your view on what cash is and what is money. And so that becomes more of a philosophical question for I mean, a lot of investors in the gold space believe that hold the gold, that's money. Why are you selling it for paper? And if you were going to get be able to stack gold in the vault after you mine it, that's a better use of your treasury than from a working capital standpoint than selling it off into the market every 2 seconds, and then you're also taking care of your market. So that's a question that most because of from an earnings standpoint, you don't get to book the earnings, so not the rest, the generalists in the marketplace maybe don't have that same view as to gold is money. So that's why it's difficult for especially the larger producers to do that.
When you invest in larger producers or mid-tier to majors, how are you perceiving the risk between sort of a startup like, 10 years ago, a startup like Lundin Gold, or 5 years ago, G Mining, versus investing into a B2 Gold, IM Gold, Agnico Eagle type, more a company that has been longer around for a longer time?
Well, Luke, that's kind of interesting. So the other day I pulled out 2003 investment list on the fund. And one thing about doing this as long as I have, you got a lot of history. You look back and still want to say, okay, where did I make my mistakes? Where were the winners? And make sure you don't repeat them as much as possible. So it's easy to repeat mistakes, especially in this business. But so the money is made really in the mid tiers, junior producers and mid tiers. The money's not made in the majors really. I mean, they kind of run with the market a bit, but if you look at where the money is made, it's made in junior producers finding companies that are able to take a deposit and really turn it into something. And that's also management, and who are the good managers that can create a company. I mean, that's the challenge right now, is who are the really good managers that's going to take an asset that's producing or can grow a company, and who is that next Mark, the young Mark Bristow or somebody, McCluskey when he was younger, and these guys that can take a company, hold equity dear, and grow a company. And so that's what we're looking for is, that's the challenge. And, I wish I had more answers for that.
Is it even possible for someone like that to show up without being connected to one of the main networks? Because Lundin Gold, of course, is Lundin Group. G Mining is at GIAX. Then you have Pierre Lassonde with Orrell and probably a couple of other companies in the last 10 years that started with nothing, but they all had backing from basically the top 10 investors in this business. So without those top 10 investors behind you, Eric Sprott maybe as well, or Ross Beatty, Frank Justra, can you do that without someone like the top 10 investor behind you?
A lot more difficult just because you have to have access to capital and be able to tap capital early on. And so, yeah, it would be a unicorn situation to be able to come out of there with, basically not having any connections to people that are already in the business.
Yeah, of course, you could be working, I mean, having a high level role in IM Gold and Kinross and maybe not having the luck or the connections to, but I guess a real promoter will find a way, especially if you're sitting in that position. So that's not really a question, but it's just something I observed that it's almost always one of the 5 or 10 groups that's behind these successful startups is maybe not the right word, but starting producers. And it's almost, I mean, there's not a lot of new people that I can think of outside of discoveries, like Chris Taylor with Great Bear, for example. I think he wasn't very well known 10 years ago, and everybody knows him right now as one of the better explorers. But in the producing business, that's probably more difficult to really show up and just run after one of those new companies.
Yeah, I mean producing gold and it's a tough business. It's a disciplined business because it's one where it's you think, okay, mine planning and then sticking to costs and making sure you don't have blowouts and making sure that your managers are delivering and staying on top of them and that you don't have some type of accidents happen, but accidents usually happen because somebody's really dropped the ball somewhere. I mean, it can be, one of the things when you're looking at producers, you want to look at, their safety records. That's usually a precursor to some issues. Their maintenance costs, if the guys are running the equipment into the side of the decline all day long, that's something that you don't want to see. How well they take care of their equipment. And so, those are important factors to look for.
So is this something that you use as well as a guide? I mean, if someone like the Lundin Group is starting a new company and you get invited to a financing, would you back something like that? Is that your modus operandi, or is it not something you do?
Yeah, no. I mean, if we like the assets, I mean, it starts with both with the assets and people. So, but you do have to like the asset and see how far they're going to take if they have the right people that are going to be able to take it forward. So one
Do
of
you
the
feel
things about, when you have the bigger groups, obviously they have the capital to withstand cycles. So
that's also the case on the major side, I suppose, but I still wonder whether the majors are doing enough. Like, are they putting in enough money, time, and effort to replace the ounces that they're currently mining? Like, to me, it feels like they're still not doing enough. I don't know if that makes any sense.
it absolutely makes sense because, one of the things that you're looking at is, what is exploration and development? It's the R&D of the business. And so, are you, one of the first things that you usually, especially in a downturn, is you cut is the exploration budgets. And so, if you look at how long it takes, a project to go from discovery all the way through the development cycle, it's a long cycle. And a lot of the mining companies used to do joint ventures, and the joint ventures, would before it became a mine, used to have to go through about 5 different joint venture partners just because, you'd go through, gold would go up, then it'd go down, the joint venture partner would back out, then the next cycle, money would be spent, another joint venture partner, and then they would, go through these cycles, and it would take 4 or 5 of these JV partners before it actually, had enough work done to become a mine. And so, what you have is, exploration budgets get cut every time you have a down cycle. And so you do have to be in a position to, if you're a mining company, to do your exploration judiciously, but keep it consistent. And so I think one of the things that we have seen, and this has been the change that's taken place since I started in the early '80s, was the bit larger mining companies. They started investing directly into the juniors, and there's been better talent in the junior space, and so a lot of the exploration geologists came out of the majors, and then they started, got into these junior explorcos and did some good work. But, not a lot, you have to really look at it. It's still, a small percentage that actually ever really create any lasting value in the junior explorco space. So you're still looking for that home run hit. If you're going for greenfields exploration, I tend to like, where capital has already been spent and time. So you want to see previous drilling that's already been done. That kind of shortens that cycle of how long you might have an economic deposit, and bring it to fruition. So it's I think for an investor, rolling the dice on the early on is exciting. It's easy to get promoted, but you have to be in a know that that might just be a little quick hit for you. Not a the odds of being taken over are not that high. I mean, everybody says, "Oh, this is going to be a takeover target." Very few actually get taken over.
Is this time going to be different? This time is different. What is that? The 4 most dangerous words in finance, but are they dangerous in mining? Because I'm thinking, are we going to do better this cycle as an industry from the M&A perspective specifically, or do you think we're going to make the same mistakes that we always do?
Yeah, at the top of the cycle, I mean, certainly, I mean, if you look back at the CEOs who lost their jobs in the last cycle because of poor M&A, I mean, they were basically littered across the board, and so that's why the bigger ones are more gun shy of doing M&A, because they don't want to be shown like Kinross buying Redback at the top of the market. They're going to be a bit more judicious, and when they buy something these days, I think. But at the top of the cycle, hey, people are drunk, and they're probably thinking it's it's all good relative value. So you'll see some poor deals done at the top of the cycle. That's why we're not at the top of the cycle yet.
Who is next then in that case, if we're not at the top of the cycle on the M&A list? And I'm talking about the acquirer as well as the acquiree.
Oh, that's a good question. One of the things, I don't really have an answer for that, of who's acquiring and who's, who will be acquired. I mean, like I said, mentioned before, I thought Newmont was going to consolidate the rest of Lundin Gold. Are you going to see some of these exploration projects that look exciting, like a snow line up in Canada? It has a lot of ounces. That's in a tier 1 jurisdiction. Looks extremely economic. Possibly. So I don't know who's who's going to be acquired, you know,
Well, what's the
just
profile then of a company that is going to be acquired? You're mentioning Snowline, so you're talking about essentially big discoveries in known jurisdictions. Is that what the next wave of M&A is going to be focused on? Or is there a specific part in the world where you're like, West Africa has big discounts right now, so why not take advantage of that? Or like, what's the profile of a company that could be acquired in the next wave?
well, West Africa, I think there's there's opportunities there for somebody who wants to be a bit more aggressive. And you'd say, okay, why doesn't West Africa resources WAF, take out War Zone, for example, which is right there. So you might see just some consolidation of some on the smaller side. I'm just thinking of, okay, who buys something on what does the major buy? A major wants to buy, like we just talked about, wants to buy a district. They want to buy it in a tier one area where they can get a tier one asset. And so, how many of those assets are out there? I mean, you have toeholds in, um, for example, Anglo Gold has a toehold in the G2 gold fields, which it seems like it doesn't make sense on their own to um, to just want to buy that asset. Doesn't seem like it's big enough yet for Anglo Gold's appetite. But if they were to say, okay, let's take out G mining and G2 goldfields together, well, that makes it interesting. Um, so, I mean, this is all hypothetical, obviously. But we're looking at how many opportunities are out there. I don't know that there are. I mean, I thought that people always ask me, we need to see more consolidation in this space. Well, I don't like to see too much consolidation. That kind of limits the options I have as a portfolio manager. One of the things that Newmont's kind of spinning off these assets is, it's created, more assets out there for the investor. And those assets have gotten repriced and they've done very well. And if you look at what Orla has done, getting Musselwhite, and then the Discovery Silver recently with Porcupine, Great Land with the Telfer, getting the other part of Havern deposit that didn't already have. I mean, these assets have done well in the marketplace. So, will those companies then look to, then try to acquire other assets and grow down the road? That's something to look forward to.
If we go back to the cycle for a moment, how to know? I mean, I looked at a couple of interviews, and you talked about buying time is important. Things often take a long time, and a company needs to, succeed through different cycles. Where do you think we are right now in terms of a cycle? And can you really know where you are? I mean, looking back to 2016, if you look back for 30 years, it's easy to say this is where a bull started, this is where a bear started. If you look back to 2016, you could argue that we are still in that bull market that started in 2016. But you could also argue that it ended in 2021 or something, and that we are since in a bear market. So, what do you think about the different cycles, and where do you think we are right now?
Well, you have the long cycle, and then you have intermediate cycles and short cycles. So, this is, I think, we have a catch up to do on the equities relative to the gold price. I think that the gold price is going to be, I thought the $3,000 gold was coming this year. I didn't think it was going to be this close this quickly. So, I think we're going to be pausing. I think $3,000 will be a bit of a hurdle, on the short term. And then, I do believe that we're on to a higher base. The base is going to be, 4,000 plus, and it's going to be similar to what $400 gold was. And all we've done here is added a zero. So if we look at $4,000 to $5,000 gold, we're probably going to see costs also trend up. That tends to be the case. But you're also going to, have good margins and good cash flows that will mean that the industry will get noticed, and the share prices will go higher. I think significantly higher. I mean, if you look at just go back to the ratios of the HUI and NASDAQ and gold and NASDAQ, gold, HUI, all these ratios, you're going to find that that these shares are extremely cheap and that they have a big catch up to do. There's a big catch up trade here, and then the capital will flow into the sector, and because what happens is once you kind of break the back of, as I've already kind of said ad nauseum here, of NASDAQ and tech, and that whole growth story, and it becomes less of a growth story, then people start looking at other places and a bit more defensive. And this defensive posturing is what will drive capital flows. I mean, everything that Trump is doing, with Doge and cutting, the government, is actually recessionary. And so, people ask, okay, what could slow the gold price down here? Well, I mean, one of the things is, if the U.S. actually does get its house in order, and the dollar would look a little bit better in that scenario, that could slow the gold price ascent. The gold price is really driven by the fact that the U.S. balance sheet continues to deteriorate, and the high correlation of total federal debt to the gold price is extremely high, a correlation of about 93%, I believe it is. Since Nixon closed the gold window in 71. So what we have is a period where foreign central banks have been buying gold. They're going to underpin gold as that monetary asset. I think the fact that you're stabilizing gold at much higher levels is going to help drive these miners higher because of that view of more of a stable gold price environment.
Yeah, I've seen you mention XAU as well, and XAU I think is something like the GDX. It's a longer term index of major gold miners versus the gold price. And you said in the previous interview that they historically traded at 5 times, 4 times. Right now they are 18 times. I think it was 26 times even in 2015, meaning the miners were cheap. For it to go back to 5x, the XAU has to go like 4x. So the complete miner index has to go up 4 times to get back to historical ratios. Are ratios really useful, or is it something, a gold price could come down again and then the ratio settles itself? How do you use it, and how useful is it?
I think it's a good tool to see. I mean, obviously, if you had a blowout in that ratio, and you could look at that, blowout in the ratio that started around 2009 or so, and say, okay, well, what happened there? And that's when I think that the shorts really started to come into the space. The space started to lose market confidence. And so, what that ratio tells you is that, when you get to some type of extreme again of confidence in the space, that ratio is going to come down a lot. One of the things that, the current level of 18-ish on that ratio tells you is that, you don't have, a lot of speculation and, big run up in values of the gold shares. And so I think that is, also telling of where you are in the cycle. One of the other characteristics of when you're get into a real strong bull market in gold and silver stocks is that you're going to get a contracting gold silver ratio, and that's still kind of not there yet. So we've got a ways to go to get some real good confirmation that this cycle is some super cycle peak out. In my opinion, we're not there. And some might question, well, then you don't have confirmation that this cycle is going to move higher because the gold shares aren't really confirming the gold price. But in my opinion, that will come. So.
How long do you think the cycle of margin expansion will continue? And why I'm asking that is because I'm thinking, will it continue for long enough in order for it to support a sustained bull market in the equity of these companies, based on what we talked about before?
That's a good question, Antonio. Because you could look at, okay, if the gold price stabilizes at say 2,900, and prices at 1,450, and you're looking at all the miners saying, okay, we're going to have 5, 6, 7% increase in costs. That kind of says, okay, well, these are probably some of the better margins. This first quarter, there are going to be some of the best margins that you're going to see for a little while. And so, and that might be the case. These might be the best margins. But, in a bull market for the shares, the shares keep on going up. You start to revalue, the ounces in the ground too. I mean, one of the things that gets lost out there is that there is value in the reserves in the ground, and it's not just how many ounces you're producing and margin on those ounces, but it's also what's the economic in terms of the economics of your reserves. And so if you have if you're increasing your reserves, or your reserves are in the ground and the gold price is going up, and they show to be economic, that's increased value. That's part of what happens sometimes when people do all these PNAVs. They're not valuing the assets past 10 years, or they're not taking in full account of the reserves. So there's kind of hidden value there.
Is there a specific company, and you can, well, preferably give me a name, where you think that's particularly the case, where the market is not recognizing value that will eventually, sooner or later, get recognized?
I mean, there's companies out there right off the top of my head. I can't think of one, but yeah, I mean, I think it's kind of, what is the value of reserves in the ground? A lot of these development companies, clearly that have 3-4 million ounces that spent the capital to drill out these deposits, are trying to move them forward. They haven't been able to get anything more than $40 or $50 an ounce of value. And you'd think that $2,900 gold, you'd start to get a better than $50, $60 worth of value of resources or reserves in the ground. So, but that's for investors to go out and look and say, hey, look, here's an opportunity. This is cheap ounces in the ground, and they're far enough long down the development cycle, and it looks like it'll be a mine. That's the challenge for investors, is say, okay, where is this project? Can it come in on this cycle? And that's part of the art of being an investor in this cycle, is being in this industry, is being able to determine whether or not a project has economic viability, and that you're not going to get blown out of the water through dilution.
What about, and that's on a producer side. What about on the explorers or developers side? I mean, who do you think is actually going to build a mine during this cycle? Last time you talked to me about Rio 2. What else? I mean, are there other companies in the explorers and developers segment that you like?
Yeah, I mean, I think I also mentioned, the next gold guys were coming around. Had a couple of projects that, up in Canada that, are moving through the development cycle. because of capital that was spent and permitting. So I still think that they're part of that Frank Justra group, Luke. So yeah, so they have some access to capital and promotion and et cetera that's needed. Um, so yeah, those are assets that I think will you know I think I still like the Rio 2 story. I think that that Oh My gold mines down in Guyana will get bought out. It's a project that's in an area that you can permit. I mean that's the big thing is okay, you might have a project that you find and discover, but can it be permitted in a reasonable period of time? And what's the economics, the geometry of the ore body that allows it to be mined and mined profitably? The Oh My gold mines, that's an old um, brownfield site. So, stocks, it's done well for us. I mean, I think, we bought it down at, 4 or 5, I think 4 cents. It's like 38, 40 cents now. So the market starts to appreciate uh, deposits. And, that's one of the things that I do look for is, there's themes, area themes. I mean, there was a time, when I think newfound gold and Newfoundland was hot. I mean, we bought a number of plays up there. We actually owned some of that newfound gold at one point on the IPO, and bought a few of the other area plays, and that became a theme, and there was a run up. And but also I looked at that and said, okay, that's what that was. That was kind of a theme, and there looked like there could be potential for a mine there at some point, but probably not for quite a ways out, and might not be on the cycle. So that's took the opportunity at that point to harvest those gains on a theme play of an area. So,
Yeah,
and I
I
think
think what it
that
shows is timing is also very important because Oh My gold mines, I also bought it. I bought the initial financing, I think 17 cents. I probably sold at 18 cents, and then there was the opportunity at 4 or 5 cents for quite a long time. So, how do you look at the timing of these things, and do you use a geologist to, because there's a lot of drill data in that company? Do you have someone going through that and seeing, looking at, hey, is this gonna work, or is it based on the promoter behind it, the person doing the work?
Luke, so I've been doing this for over 40 years. So, I have a pretty good smell for, looking at, cross sections and long sections and drill data and metallurgy and, what works and what doesn't work, at least on the back of the envelope for me. And so, so that's, so we just do it all here. And so that's what I don't, at this point, uh, when I want to bring in a geologist to consult on something, it'll be more along the lines of structural and, to see how big something can be. And so that's when I'll bring somebody in, and I'll just bring a consultant, and then, I have a few guys that I work with. So,
Looking at Oh My goals, I mean, do you think this is a good example of where timing is crucial? I mean, sometimes an IPO doesn't really work out. I mean, maybe there were people able to sell already with a profit at that point. The stock's doing not well for a number of years, but the deposit is there. A lot of work went in, like you said earlier, and the opportunity presents itself at lower prices.
yeah, it's a timing thing. It's just where you are in the cycle, timing, and timing is extremely important on uh, in this space. So if obviously if a cycle rolls over, and especially in the junior cycle, what we know is that the capital dries up. I mean, the junior explorers, all they do is eat capital. And so if that market is turned off, what does the market do? It starts to discount that you're going to need to dilute. So the share price goes down further and further in that discounting process. So, somebody will always give them some money if they have something, but, at a price, and that price is usually going to be much lower. And so, down the case of Oh My Gold Mines, I mean, we got, basically, down there 4 or 5 cents. I said, okay, well, this is trading for nothing. And, we like the area. And so I think at the time it was probably about a $4 or $5 million financing down there. But that ended up being the bottom. And then, and then she turned around and did another financing at 10 cents, another one 15. And, she likes to do financings. So,
Do you think the narrative played a role? I mean, of course, Guyana is a popular place right now with several companies having success. Do you think that narrative also changed, and that's why Oh My Gold was able to raise more money and got more interest from the market?
absolutely. I mean, you took out Reunion Gold, that created some liquidity, and so that was a liquidity event that then could get recycled into an Oh My Gold Mines. People said, "Oh, geez, I was successful there, so let's put some money over there now. So see if I can hit the daily double." So yeah, no, absolutely is. You know, you get a sniff of that an area is going to become more of a favorable to investors, and then just like West Africa was for until you had this recent um, turnaround in Burkina and Mali. People wanted to be in West Africa, and you weren't getting a West African discount; you had a West African premium. So yeah, there's definitely opportunities on themes, and where market, and that just basically means that the market narrative changes to where investors are comfortable.
I'm still dreaming about that West Africa premium and it coming back. I can definitely use it myself. Um, what about other places? I mean, I can use a Central Asia premium as well. I've recently been deploying capital into Kazakhstan. Are there any other exotic? I don't want to call them exotic places because they're not exotic, but they could be exotic to many North American investors. Places that they wouldn't typically go into. Is there some place that you're currently deploying capital in?
No, nothing new. One of the I think what we have to look at right now is there's a lot of question marks, going back and forth, with tit for tat on tariffs with the U.S. Mexico, I think yesterday said, okay, well, we're gonna make it, more difficult for foreigners to come in on, our deposits. What does that mean for, investing in Mexico? What's, what are the opportunities in, Latin America? These things go through cycles. Some of the big companies I can remember, I forget, was BHP, and he said, "Well, we're going to be here longer. We'll probably go through, four or five different cycles of, communism, socialism, capitalism, while this mine's here." And that's one of the things that does happen. Obviously a bigger company, they can afford the headline risk, whereas a small company can't. So that's, as an investor, that the market doesn't like headline risk, and so where you wake up one morning and say, "Oh crap, you're down 80% or something like that." That was, yeah. Eritrea with Nefson used to have a headline risk, and then everything that had was in there, Sunridge and Nefson, the share prices would get totally blown up, and then everyone said, "Oh, you got diarrhea, Eritrea, diarrhea." So it wasn't a whole lot of fun. So yeah, you don't want to be too exotic, is what I'm saying. You want to make sure that you're going to have sanctity of title, for the company.
Mm.
And so that, people like Morocco these days. That's probably, you're seeing more people also open to being investors in Saudi Arabia. So, you know, those are probably in terms of themes that are out there right now. I think is Morocco is Lundin Group backed, that spin out from Aya Gold,
Yep.
MIX or whatever they're calling it. So
one of these days we're gonna organize a stand-up comedy show with fund managers, and we'll make you the star of the show. What do you think? You're mentioning tariffs, and I'm thinking about Canadian mining. Some people believe Canadian mining needs saving, and I don't believe that tariffs would be saving Canadian mining. What do you make of that connection there? Is there going to be any effect in the market when something goes through, or I mean, within the next 4 years?
the tariffs would save Canadian mining or
would not. I don't know. I was trying to
would
be
not.
funny. I don't even know what I asked actually when I go back and think about it for a second. What do you make of Canadian mining and tariffs?
Uh, look, there was interesting that somebody, I forget, one of the earnings calls, the question was brought up as, what, impact tariffs would have on, the company. And, I found it, a bit odd that they said, yeah, we might see, or maybe it was just an excuse for trying to say their costs were going to go up. But yeah, we think we might see, you know, uh, 5% potential increase on costs from tariffs. And I was thinking that there's that much, consumables or that are going back and forth across the border that are being used in the mining space. I thought that would be a bit surprising to me that there would be a cost impact from tariffs um, in the mining space just because it seems like there's enough localized sources for um, materials, but also mining equipment of where it's manufactured. Um, so yeah, I'm just it's still unknown at this point what impact tariffs are going to have on the mining space in terms of costs, in terms of investment into the space. Um, I think that we will see, tariffs creating tension. I think the tension is going to drive investment.
Hmm.
And I think that's one of the things that, uh, Trump, you know, he leaves a bit of a wake of chaos behind him. So, and that chaos probably is, a good underpinning for the precious metals equity markets um, and the space in general.
Hmm. Well, one more thing before we let you go here, Greg. We talked about margin expansion, and I had it on here to ask you about the royalty companies, because if the producers are getting margin expansions, then the royalties should be doing even better. Is that the view that you're taking, and is are you deploying capital into the royalty companies?
Yeah, I'm not. Yeah, some guys are big on the royalty space just because it's less. It's viewed as less risky. I'm not. I always view the royalty space as defensive. And if you believe you're in a bull market, you want to be more offensive. And so, right now I'm not looking unless there's opportunistic situations in the royalty space where I can see some growth, and there might be a couple out there that I am looking at. Um, so, but overall, they want to be more like Franco wants to be viewed as a merchant bank more than a royalty company, streamers. And so are you going to start to value these companies as like on banking multiples or the extreme high multiples as that they have right now, like on Franco? So so you might get margin uh, compression on on the royalty companies if they're viewed as being banks rather than strictly a streamer or a royalty company.
That's actually an interesting take. I think most people, Luke, you and I talk to, they are bullish on the royalties and kind of like, when it comes down to revenue generating companies, they go the royalties route. And when it comes down to non-revenue generating companies, they go the prospect generator route to avoid that risk. But Greg, you make a good point here. What else, Greg? What are we forgetting to ask you here at the end? Anything that you came here hoping to talk about that we failed to bring up?
I think we've hit on a lot of things. I think probably, what a lot of people want to know is do we have further room to grow on both on the gold price and in terms of these gold shares. And I think that I think we have further to go on, especially on the shares. As we've talked about, other markets don't look as attractive. I think the gold space will remain attractive. I think that there's still some fundamental problems, within the structural issues that I don't know if Trump and Musk are going to be able to solve. And obviously one of the big questions have been out there over the last week or so. They were saying, is the gold really in Fort Knox?
Is it?
Well, as Donald Trump said, well, I sure hope it is. It's going to be a problem if it isn't. We're going to look. I don't think you'll ever find out. That's not something that is for one reason or another that that we would find out if it's there. That would be an absolute disaster for the dollar if the gold wasn't there. And my belief is that it is there. I mean, there's a reason why gold's in Fort Knox. I mean, and this is what gets lost on a lot of people is that gold is it's a military asset. And when you go to war, there's and this is why at West Point, they've talked about gold, and there's the discussion of gold as a military asset because if you're looking like you're going to lose the war, nobody wants your paper because your currency might not be worth anything. You can think about the Confederate U.S. Civil War and what happened to Confederate paper, and so you have to have the gold from if you were ever to go to war because you might need it in order to buy the supplies that you have to have in order to keep the war going. So I don't think that the U.S. military would have let the gold out completely, but there's all the stories of back in the late 60s that the coin melt was coming in and showing that the U.S. didn't have any good delivery gold left and they were getting near the bottom. And I mean, those, then there might be some truth to that. I think that, there has been a lot of work done on that in terms of, postulating, what the reason why they were down to coin melt. But maybe we'll find out. I mean, I heard the Treasury Secretary say, any senator who wants to go see the gold can see the gold. But Rand Paul said he put in a request to go see the gold numerous times and was never able to see it. So, but there are reports supposedly that they have the vaults sealed and that they don't need to assay and count the bars anymore because the vaults are sealed. And so, maybe that's true. Let's hope that it's there. Like Trump says, let's hope it's there.
We're hoping. And this sounds like a podcast in and of itself. Greg, I appreciate your time today. It is ocmgoldfund.com for people listening, but it's also going to be on their screen. Thank you so much for sitting down with us.
All right, Antonio, Luke, thank you. It's always fun. So we'll talk to you guys again.
And thank you to everyone for listening and watching. This was an interesting conversation. Any and all questions for future interviews are, of course, welcome. Please post them in the comments. But I am still going to kind of repeat the warning that I said at the beginning, that everything, everything combined with the warning that I gave you at the beginning is to say that you should treat this program as biased entertainment instead of unbiased journalism, because there will always be some type of bias in what everyone tells you online. They may own shares of the company, they may be a director, they may have been paid by the company, and so on and so forth. Now, this entertainment program specifically is intended only for experienced junior mining speculators, because mineral exploration, development, and mining is a very tough business. Losing money is the norm and should be the expectation, as this is a very complex sector, and the performance of individual companies typically depends on many different things, including geopolitics, macroeconomics, commodity prices, and many other moving particles that are typically outside of anybody's control, and no one can really foresee them, because unfortunately, and believe me, I have tried and I might even keep trying, though I doubt I'll ever be successful. I just don't possess any superior knowledge about the potential direction of any stock or commodity price. And at least to my understanding, nobody out there does. So you should not rely on this program for directional advice or advice of any sorts, as this was a conversation that was general and impersonal in nature between a couple of individuals, none of whom are your licensed financial advisor and none of whom can see the future. So no guarantees can be made about future events, and past performance is not a guarantee of future results. So please talk to a professional licensed investment advisor with a good long-term track record, as well as do more research before taking any decisions by visiting setterplus.com, where you'll find the official filings of the companies that might have been discussed in here today. And if you don't do that, you're highly likely to lose your money. There's a couple of documents that are absolutely obligatory reading for people interested in the space. And that is, of course, the MD&A, which is the Management Discussion and Analysis. And it's an official document that the company publishes on setterplus.ca. You want to look at the financial statements of any company and understand how and why and where they spend money. And you also want to look at the Management Information Circular, which is going to tell you how much money each insider of a company earns in total compensation, bonuses, and everything, and all the other incentives that they might have. It's also going to show you if there are any change of control fees and whatnot. It's a very important document. And then, of course, this is a technically focused business. So you also want to read the NI 43-101 technical disclosure. And again, if you don't understand it, consult with someone who does understand these things, because if you don't do that, you are highly likely to lose your money. So yes, thank you so much for listening to this. And I'll leave you with one of my favorite Charlie Munger quotes, which was, if you don't understand it, don't do it.